Welcome back. After the lunch break, we continue with our third session on applying stress testing and current systemic risk modeling in macroprudential policymaking. First, we will hear the keynote presentation of Mr. Serafín Martinez-Jaramillo, manager of the Environmental and Social Risk Analysis and Policy Unit at the Bank of Mexico. Afterwards, we will hear the presentation of Mr. Bence Mérő, senior economist at the Magyar Nemzeti Bank. Mr. Mérő, please take a seat on the stage. And Mr. Martinez, the floor is yours. Please give them a warm welcome.
Thank you very much. It's always hard to give the first talk after lunch, so I appreciate your generosity of being here. And I also want to thank the invitation from the Magyar-Nemzeti Bank. Thank you so much. And SEMLA, always. And ONFIF, it's a pleasure to be here. So I'm going to be talking about stress testing, but for climate change in particular. So this is an exercise that we have been doing in Mexico for about 2-3 years. So it's quite some work already put on. Now, I have a disclaimer always to say that the views expressed here today are mine and do not represent the views of the Mexican Central Bank or its board. So, and this work is based on it's getting old paper in 2021, but the work before was also took some time together with people from the University of Zurich, Alan Roncoroni, Professor Stefano Battiston, a colleague of the Central Bank of Mexico, and myself. Now, this is the broad summary of the presentation, so I don't want to lose any of you, so I'm going to go very briefly through some of the most important things. Is that the climate risk analysis should be forward-looking. That's the first point to remember. That the climate scenario analysis is one of the key elements and tools that will allow us to do this. And the current asset valuation tools and methods are not incorporating, as far as I know, climate-related risk and more broadly environmental risk. And the sudden realization of this happening might bring abrupt price changes in some assets, physical and financial assets, and this could be a problem for the financial system. So this is what transition risk means. Now, this model is mostly for transition risk, but I would like to say something about the physical risk too. And there could be additional aspects to consider, contagion in particular. So it's not only the direct effects, but also the contagion effects through the financial system, very well studied by our colleagues from the University of Vienna, as we saw from Professor Turner's work. And this is one operational framework that we proposed then and that we have been following and using more recently. So now on the motivation, well, there are concerns that the policies to mitigate climate change might cause unintended consequences on the financial system, and that there is the risk of a disorderly transition to a low-carbon economy. So this is transition risk. And an adequate assessment of this risk is of interest for us, the financial authorities, but also policymakers and a wider audience, financial institutions as well. There is not such a framework still widely accepted, so this was a proposal then, and we have been trying to use it currently. And this scenario analysis you have been hearing a lot more because of the NGFS. The NGFS is the network of central banks and supervisors for greening the financial system. Bank of Mexico is one of its 8 founding members. So we were there from the beginning. Now there are more than 120-something members among central banks, international institutions, and supervisors. Now, Mexico is highly exposed to climate change on its both forms. Transition risk, the one that I've talked about, but also to physical risk. And on physical risk, Mexico is exposed not only to chronic risk, but also to acute. I was mentioning yesterday that the type of risk that captures the minds of most of the public is acute risk. So when we imagine climate change, we see hurricanes, we see floods, but there is another component which is far more important, which is the chronic risk. And the impacts of chronic risks don't go away. They arrive, they stay, and then we are worse off than we were before this materialized. So this is a key component. Now, Mexico on the transition side is also very exposed to this transition risk because of the composition of the energy matrix. In Mexico, most of the energy comes from fossil fuels. That means oil, that means gas. And also the electricity generation comes mostly from gas. So this puts Mexico at risk of a sudden transition. Now, this composition of the energy matrix brings other risk. For example, reputational risk, because we are not doing enough as a country. Or cross-border adjustment tax. Just like the European Union is starting to implement this adjustment mechanism, this might hit the Mexican economy because we will be charged some additional tax because we are not doing enough to clean the energy matrix. And even the possibility of having contagion to sovereign risk. Now, the questions that we wanted to answer with this paper is how do we build a science-based climate scenario analysis for the financial system, the Mexican one, but this applies to any financial system. How do we translate forward-looking knowledge and the science from climate science into economics and metrics in order to measure the risk that the financial system might be taking on? And what are the policy insights that we can get out of this exercise? Now, the contribution is that we have many contributions in the past with this paper, is that we have, in addition to direct impacts, we have the contagion impacts within the banking system and the other financial intermediaries. We have also the interplay between climate policy shocks and financial market conditions. And also the second policy implication is that in the face of possible disorderly transition, the financial institutions have an incentive to engage earlier under the same market conditions. We'll see that with very concrete results. And the second policy implication is that it is possible to reach tighter climate policy targets at the same level of risk if market conditions are strengthened. The methodology is based on this previous work by my co-author Stefano Battistone and Irene Monasterolo. Those are the previous works. Also work on the network evaluation of financial claims. That's what takes care of the contagion mechanisms. And common asset contagion, do you know this by overlapping portfolios or asset fire sales? This is two works, Gringo et al. And Paulette et al. Is a paper also in which I collaborated, and Professor Turner is also a co-author of this paper. Now, the data that we use are the economic trajectories from 6 climate economic models and 9 scenarios from the integrated assessment models under a limits database. This work was before the NGFS established very well the NGFS scenarios. So that's why you will see some scenarios which are non-NGFS, but the more recent results are for the NGFS scenarios. Well, we have also additional data on the financial system that can be used for these purposes. For this, we need, obviously, the credit registry. We need the holdings of securities of the banks, and we need the equity holdings as well. And we need the interrelationships between the financial intermediaries. So all of that we had at the Bank of Mexico. And we need something additional, which is the climate policy relevant sectors. These are the economic sectors that might be exposed to transition risk. These sectors are not only the ones, economic activities with high emissions, but also the ones that participate along the supply chain with these high emissions sectors. Now, this is only a description on how the exposures of the financial system is to these sectors. You see the energy intensive, the utilities, and the transport. And you see the coverage is quite wide. So we have securities, we have loans from the brokerage houses, commercial banks, development banks, and the investment funds. So the coverage is quite good about these exposures. And then here is more specific about the CPRS. So we have oil, we have electricity, we have fossil fuels, energy supply. Well, that's the bedrock of the world. That's something that you need to be done at your individual central bank in order to start understanding how much your financial system is exposed to possible transition risk. Now, the model has many interesting features. It's the one at the bottom. It includes endogenous recovery rate, an ex-ante evaluation of the network effects, fire sales or contagion. It includes also investment funds, not only banks, and it has a climate module. So it's one of the more comprehensive. And this is one of the things you saw yesterday. In fact, this is one coming from the paper with Professor Turner. And here we have the direct exposures between financial institutions. We have the one on overlapping portfolios, which are the indirect exposures, and then we have a combination of it. And what did we do with this? We have that the systemic risk from overlapping portfolios is far larger than the one originated from direct exposures. That means that there is a lot of overlapping on the banking system. That's why the effect, if you see, is tremendously. So all the things that we have been studying on the contagion works are the ones at the bottom. So the blue area and the red area. But when you include overlapping portfolios, the exposure is a lot larger. Now, this is the type of financial network that we have. We have banks, we have funds, and we have the asset classes that you see here that there is a lot of overlapping, not only on the banks, but also from the investment funds. Now, we have we have climate policy shocks that comes from disorderly transitions. So that's the origin of the shocks. And on the first round of losses, these are the losses that could be suffered directly by banks which have exposures to these sectors. So that's the first round of losses. On the second round of losses, we have the interfinancial contagion mechanism. That's the second round of losses. And on the third round of losses, we have that the banks and funds need to react to these initial losses, so they go and sell some of their securities. But because there is a lot of overlapping of portfolios, the asset fire sales kick in very, very badly. And on the fourth one, once we have exceed the bank's capacity to absorb these losses, these are passed directly to the external creditors. So, and that's how it works. So we have at the top, you see the emissions for Mexico, greenhouse gases emissions, and you see the different scenarios. So you see the current policies, you see another scenario, and you see the ones on the transition, the ones at the bottom. Those are the ones that means that there are going to be policies to mitigate emissions. From there, you can obtain from one of the models the evolution of the output of the energy system, which is going to be used to compute the impact on the securities, on the financial assets. So the output will tell you if a sector is going to grow or if it's going to shrink. And depending on that, that will cause these losses to the financial institutions. This is something that you see on the picture, on the plot at the middle. And then, including the contagion, you will have the final impact of these policy shocks. So this is transition risk. So these are the emissions under different scenarios for Mexico. You see the ones at the bottom, again, they cause reduction on the emissions. Now, this is what I refer. When you are under current policies, which is the red line, so this is the trajectory of the sector. But if there is a switch on policies, a different trajectory for the sector is created. And the difference between the current policy and the mitigation trajectory is the one that is going to be used to calibrate the shock to the financial instruments. For example, let's take the red line and the blue line. if you see the difference, that is very big. This means that if we go under current policies, the sector will have this output, but if we go to a trajectory in which there is going to be a transition, a delayed transition, then the impact is going to be very big. That is the risk that we want to compute. And that is the risk that we would like to be included on the financial valuation of assets. So this methodology that Stefano and Irene are proposing is a way of incorporating transition risk into the value of financial assets. It's not ours, it's theirs, but it's good that there is a model that wants to include this on the financial assets. But not all the sectors are going to lose, and this is important. If you see here, the coal-based electricity generation was always shrinking, even under current policies. But some of the sectors might grow, and those are opportunities on the energy transition. So that's how institutions could decide in which sectors is worth investing. I'm running out of time, so this is only an illustration on how contagion works. So you have a climate policy shock on one of the climate policy relevant sectors. This causes some impacts on some banks, and then through direct contagion, and then overlapping portfolios, additional losses are caused, and then when the losses are not enough to be absorbed by the banking system, they go to the external creditors and depositors. The same happens with funds. They are exposed to these sectors. And now, this is one of the first results. And what I like a lot from this is that you see that the direct losses are rather tiny, but then the contagion ones, which is the orange, yeah, it looks very nice there. The orange one, you see, are sizable, but the biggest losses are coming from overlapping portfolios. That's why it's very important to not to have these unintended consequences of asking all the banks to invest on government bonds. So there is this is because basically there is a lot of overlapping on the Mexican banking system. Yeah? Now, this is one of the policy implications. So under the same market conditions, a more strict climate policy scenario have larger shocks to the financial system. The one that you see on the right, yes, on the right, is a more strict policy type of scenario. That means that if we are more ambitious into mitigating emissions, then this could have a larger impact on the financial system for the same market conditions. And the second, under the same market conditions, a disorderly transition to a stricter scenario may lead to the same level of losses if the alignment occurs earlier. So that means that disorderly transition is also not a good way of thinking about this. So, and the third one is that if the market conditions are improved, then you can adopt more ambitious targets, and you will have even maybe lower losses. So this is the third one. And you can, as there are some parameters of market volatility, the recovery rates, then you can do a quite exploration of the parameters using this. Now, the conclusions. The first combination of climate stress test and network valuation of assets, so this means the contagion mechanism, analytical and empirical. So you saw the empirical results, but this is proof analytically. So this means that these implications are proved analytically on the model. And also that in the face of a possible disorderly transition, there are incentives for these financial institutions to engage earlier. And it is possible to reach tighter limits climate policies if the financial conditions are strengthened. Now, on the next steps, we have that this methodology is being adapted for the climate scenario analysis for Mexico, but we are going to use the NGFS scenarios this time, and we are going to use a suite of models in order to include physical risk. Again, this was only transition risk, but physical risk is also very important. And as I always said, is if you think that the transition is expensive, if you see the implications of the physical risk, then you wouldn't think that way. Because the possible costs for the Mexican economy on the physical side are huge, far larger than the ones on the transition side. Now, we have an additional scenario that we are developing. I have 43 seconds, in which we want to investigate what will happen if the world is moving to a net zero target, but Mexico wants to play a free ride role. What could happen? And that's very interesting results. Some of the preliminary results that I can show you very quickly is that emissions do not stay at the level that they were. This is the one. So the red line is the current policy scenarios. And the scenario that I was talking about, the asymmetric one in which Mexico wants to play the free ride, you see that the emissions increase and increase a lot. Why? Because there is carbon leakage, as some of the high emission activities are moved to Mexico from our trading partners. And these higher emissions have problems, reputational problems, investment problems, because now that the emissions are going to be computed by most of the companies, this means that in Mexico we don't have the clean energy matrix. That has implications for investment in Mexico. Not only reputational, but also investment. And we're talking about the car manufacturing, which is huge in Mexico, but also the electronics, which is also very important for Mexico. So this is one of the things that could happen if we decide to play the free riding role in Mexico. And if you see the other transitions, even the delayed transition and the one that implies an orderly transition, we see a reduction of emissions, an important reduction of emissions. So I hope I could have more time to talk, but for the time being, that's everything from me. Thank you.
Thank you, Mr. Serafín. Mr. Mérő, I pass the word to you.
Thank you very much. Good afternoon. In my presentation, I'm going to talk about agent-based modeling for macroprudential purposes. I would like to give you an insight into what agent-based modeling is capable of now and how it can help the conduct of macroprudential policymaking. Here you can see an outline of this presentation, in which the views are that of the author and do not necessarily reflect the views of Magyar Nemzeti Bank. So, in the beginning, I would like to talk about what agent-based modeling is, and then I would like to introduce our agent-based housing market model, which we developed here at the Central Bank of Hungary, which is actually a one-to-one mapping of the Hungarian housing market. And then I would like to show you a use case of this model where we investigated different borrower-based macroprudential policy measures. Okay, so agent-based modeling. Actually, agent-based modeling is a simulation in which we simulate the actions and the decisions of all the agents in the model one by one with feedbacks. You can see the main characteristics of agent-based economic models. The first one is the bottom-up approach. So in the model, we have individual agents making individual decisions. And then actually, these individual decisions will have an aggregate macro effect. So we build from the bottom up. These agents can be individuals, households, firms, and banks. So we have multiple types of agents. And regarding all types of agents, we have heterogeneity among these agents. Regarding the income of individuals, the wealth of households, the productivity of firms, or what price firms charge for their products. So we have heterogeneity along multiple dimensions. Okay. Now, each agent can have its own parameters, and we keep track of the current variables of the agents. Now, agents are characterized by bounded rationality. So our agents in the model are not perfectly aware of the functioning of the model itself. So their expectations are not necessarily model consistent. And actually, when we make decisions, they do not necessarily optimize, but rather use rules of thumb. But these rules of thumb can be based on empirical findings as well. Okay, we have direct interactions among agents. So for example, usually there is a specific buyer and a specific seller in a market transaction. And in other cases, the decision of one agent can be affected by the decision of other agents as well. For example, if we purchase a house, our decision can be affected by our peers, what types of houses our acquaintances has purchased before. Okay. Usually there are selection-based market mechanisms. Agents may choose on the basis of market mechanisms who they established contact with. So, for example, we have a consumer, and when it decides which firm to purchase from, then it randomly visits a set of firms and then chooses the firm offering the lowest price. Or if it purchased the product from a firm in one period, it can keep this contact, and in the next period it keeps this contact and visits another set of randomly selected firms. Okay. So these are the main characteristics of agent-based economic models. And while mainstream models constitute of solving equation systems and everything is determined in a simultaneous manner, in agent-based models, we have a sequence of events within each period, which we have to code. But actually, it gives us great flexibility. So when we use different assumptions, we are not confined by equation systems. We do not have to condense our assumptions into tractable equation systems. So it gives flexibility. But it does not mean that we can use just any assumptions. We have to pay attention that our assumptions be realistic and based on empirical findings. Okay. So we can code our model and then run it, but we also have to calibrate our agent-based model as well as mainstream models. Okay, so we use a set of rules, we try to calibrate it, and if we cannot calibrate our model well enough, then we need to change some of our rules in our set. Okay, so I think agent-based modeling is quite suitable for macroprudential purposes. First, because it is very flexible and we can have a complex set of rules in the system. We can adapt our models to very complex rules. And also regarding financial stability, that agent-based models are suitable to estimate more profoundly the economic losses if we populate the agents using granular databases. So regarding financial losses in economic downturns, the losses are not just the losses of a representative agent, but the overall loss is affected by single loan contracts and single characteristics of single loan contracts. Okay. So let me move on to our agent-based housing market model, which is a one-to-one mapping of the housing market, including households, flats, and the loan contracts themselves as well. Okay. So here you can see a schematic outline of the model. We have flats which can be bought in the housing market or rented in the rental market. In the housing market, we have households who wish to be owner-occupiers or first-time buyers. We have buy-to-let investors who can then rent out the flats in the rental market. And we also have a construction sector which accommodates the housing stock to the needs of the population. On every main building block, I have a short slide, but I cannot go into the very details of the model. But if you are interested, we have published our model in October in the Journal of Economic Dynamics and Control. Okay. So, flats. In our model, flats have 3 characteristics: size, location, and state. Regarding the location of the flats, we have divided the country into 124 actual interpretable neighborhoods, and then we estimated a cardinal quality value to all these neighborhoods. Now, these neighborhoods are all part of the 8 NUTS2 regions in Hungary, so we can aggregate our results at NUTS2 levels. Okay. Regarding the state variable is a composition of several measures. It includes the construction year of the house itself, the general state of the flat, type of heating, insulation, and things like that. Now, state can change period by period. A flat state depreciates automatically, but households can renovate the flats and thus increasing its state. Now, within each location, flats are grouped into buckets. Flats within a specific size and state interval constitute a bucket, and we again collect some data on bucket level, which can help the decision of agents in the model. For example, we can collect vacancy rates at the bucket level, which then helps buy-to-let investors what type of flats to buy and rent out. Okay. Now, regarding households, we have individuals constituting these households. Individuals age, they can marry, they can give birth to children, they can die. These processes are generated according to empirical data. Individuals earn wages, and what is affected by the educational level of individuals and the working experience, some individual factors as well. Now, households can consume out of the earned income, and they can also accumulate savings, and with the savings, households can purchase a flat. But in some cases, they can be they might need credit, mortgage loan, to purchase a flat. In this case, households must comply with the regulatory requirements of the loan-to-value and the debt service to income regulation. Okay. We have first-time buyers appearing on the demand side of the housing market, but we also have owner-occupiers who decide to move to another flat. Now, owner-occupiers are randomly selected to make a decision about moving, and they move if they find that by moving they can achieve a significant increase in their consumer surplus. Okay, so we have buy-to-let investors in the model. We have a representative professional investor and owner-occupier households as well. This representative investor represents firms active in the rental market, but also foreign investors in the Hungarian housing market. Demand is influenced by the obtainable capital gain. So it is influenced by price changes in different segments of the housing market and also by vacancy rates. Actually, vacancy rates determine the markup which can be charged in the rental market. Okay, now in different buckets, different segments of the housing market, the supply and the demand side can be temporarily detached, so there is equilibrium, but there are some endogenous processes going on, like price change and change in the rental markup, which can ensure the long-run convergence to equilibrium. Okay, and we have a construction sector. This is also represented by one firm in our case, which can take high-quality flats to the market. Actually, this way, the construction sector can accommodate the housing stock to the changing needs of the population in our model. Because the composition of the population changes, and as GDP increases and income increases, the need for quality housing might change as well. So construction sector builds high-quality flats, but the construction sector needs land sites to build the flats. So if it does not have enough flats in a given neighborhood, then it goes to the market and purchases the flats with the lowest unit price available. Construction takes 18 months, so there is a friction. But the flats can be sold even during construction. Actually, the percentage of flats sold during construction determines the markup used by the construction sector. Regarding the rental market, we distinguish between short-term and long-term lending. Short-term renting represents online marketplaces like Airbnb, and it is exogenous demand. But this demand is time-dependent and again based on empirical data. Now, the reason for implementing it into the model is that in the inner districts of Budapest, we see a very significant house price increase, which was mainly due to the high percentage of new Airbnb participants. And then it spilled over to other segments of the housing market. Okay, but what is even more important is the long-term renting in our model. If a household does not have an own home, it can go to the rental market. Now, in our model, each household tries to have its own home. It wants to be an owner-occupier. It only goes to the rental market if it cannot purchase an own flat, because it is credit constrained. Okay. Regarding the credit market, we have different types of loans. The most important is the housing mortgage loan to purchase houses. But besides that, we have bridge loans for owner-occupiers who move. And we also have consumer loans for renovation, which is also a mortgage loan. Now, a household is eligible for a loan if it meets the regulatory LTV and DSTR requirements. But the bank can also prescribe its own regulation. The expected income must cover the credit payment and a minimal consumption level. Now, actually, this minimal consumption level can be set procyclically by the bank in our model. In economic downturn, it increases the minimal consumption level, so actually it makes lending more stringent to be a bit more prudent. Okay. If a household does not have enough income to cover the monthly payments, it first tries to reduce its consumption. But if it becomes non-performing, then the bank first tries to restructure the loans, and then the collateral is liquidated. Okay, so it is a one-to-one scale mapping. Using granular databases, we populated the model with 10 million individuals, forming 4 million households. We populated the model with the housing stock, reconstructing the housing stock in such a way that it mimics the aggregate statistics. And we also implemented the existing mortgage loan contracts in the Central Credit Registry. So we populated the model as of 2018 January. It's a one-to-one mapping of the Hungarian housing market as of 2018 January. And then we could start the simulation. Okay, now, how well our model performs. Here you can see the results of our calibration. We calibrated our model to match the empirical data regarding average regional prices and the number of transactions and newly built housing stocks in the first 2 years of our simulation. I think that the prices regarding the regional level are quite convincing, just like the number of transactions, the overall number of transactions and transactions in the newly built markets. Okay? And to validate the model, we looked at some variables which were not calibrated. Here you can see the distribution of volume of newly issued housing loans according to income size of households. And I think that this mimics the real-world data quite well, just like the volume of new credit flow and the number of loan contracts. Okay. And so let me move on to show some of our results. So we made many applications with this model. One is this macroprudential policy application, in which we evaluated different loan-to-value and debt service-to-income caps. Okay. So in the context of the housing market, the goal of macroprudential policy is to inhibit the buildup of vulnerable loan portfolios and to restrain the volatility of the prices of the housing market. to have a safe collateral value. Okay, now when finding the optimal trade-off between stability and the cost of regulation, we need to take into consideration different types of costs besides the stability and economic growth trade-off. And with this model, we can take into consideration social welfare and inequality consequences, and also the effect on the housing stock quality and energy efficiency as well. And we can assess the policy impact along multiple disaggregated dimensions, geographic, social, and economic dimensions, for example, the number of first-time buyers, or the distribution along the LTV and DSTI categories. Okay, so we had 10 different policy scenarios, a baseline scenario with an LTV of 80% and a DSTI of 50%, and then we used three versions of LTV and DSTI caps, an unchanged one, and increasing and decreasing the value by 10 percentage points, and taking all the possible combinations. And we also had a no-limit scenario without an LTV and DSTI cap, but in this case, the commercial bank still prescribed a minimal consumption level. Okay, I can show only a few of our results. So here you can see the deviation from the baseline regarding house prices. Now, the blue lines in the middle represent the baseline LTV, the yellow lines the linear LTV, and the green line the strict LTV. And the black line is the no-limit scenario. Okay, now the solid and different dashed lines represent different DSTI values. As you can see, the results are mainly driven by the LTV and not the DSTI. As you can see, if we loosen the LTV, it can lead to bubbles. Now, actually, in the case of the no-limit scenario, there is a huge increase in house prices, and this bubble bursts endogenously. Okay. If we decrease the LTV in a case of a stricter regulation, the volatility of the house prices decreases only to a little extent. So our results are not symmetric and are not linear. Okay, here you can see the volume of newly issued housing loans relative to the baseline scenario. So you can see that in the no-limit scenario, it is similar to the foreign exchange lending path before the great financial crisis in Hungary. And you can see that the risks can also materialize in an endogenous way. The default rates, in case of the no-limit scenario, skyrocket. Okay. Okay, and we can make other types of analysis as well. Regarding credit availability, we wanted to know what the frictions in the credit market are, what are the most binding conditions regarding the credit market. Now, we wanted to know whether different types of households can afford a justifiable flat, and if not, what is the binding criterion. By justifiable flat, we mean the average flat in the region and the income decile for a given household. We have 5 categories. One is when no credit is needed for the transaction. The second one is when credit is needed but there is no constraint. The third one where the LTV constraint is binding, and that is the most binding criteria. Then we have a DSTI binding and the consumption criteria binding. So we have these 5 categories. And we have disaggregated results according to first-time buyers and owner-occupiers and different income deciles. Now, the upper figure represents the prevailing regulation, the bottom, the no-limit scenario. As you can see, owner-occupiers can mostly buy their flat, and the LTV and, or the consumption constraints mainly below the median income. While in the case of first-time buyers are very constrained. Even in the no-limit case, the first 3 deciles are not eligible for credit because they do not have enough money for this minimum consumption level set by the bank. Okay, and even in the 7th decile, only around 50% is eligible. While regarding the prevailing regulation, barely anyone is eligible for enough credit. Even in the 10th decile, only 50% is eligible for enough credit to buy this justifiable flat. But it does not mean that they cannot purchase a flat at all. It just means that that flat should be below the average value. Okay. And here you can see the evaluation of the different policies according to different aspects. As you can see, the most balanced policy seems to be the yellow one with the 80% LTV, so the current regulation. Okay, and just a few words about our plans regarding this project and other agent-based modeling projects here at the Central Bank of Hungary. So we made this pilot project. We already made many applications with this model, like the one I just showed you, this macroprudential policy application. But we already analyzed construction costs and some family support policy measures. We also analyzing some targeted first-time buyer subsidies, and we're also investigating scaling issues in this model. And we plan to incorporate macroeconomic feedbacks into this model with the help of a structural VAR model governing the evolution of the macroeconomic variables, GDP, interest rates, things like that. Okay, and then we plan to develop a macroeconomic agent-based model, which could be suitable of analyzing all the main macroprudential instruments within one complex framework with the proper feedback channels. And in the very end, we plan to incorporate this housing market model into the macroeconomic framework. Okay. Thank you very much.
Thank you very much. Now we would like to open the floor for questions from the audience.
So, well, first of all, thanks a lot for these excellent presentations. I have a question for Serafín, giving your, let's say, advantage point of stress testing, and we know that stress testing is not only about calculating the amount of risk that could materialize in the system, but it's also a way to tell us a little bit more about what are the mechanisms at work through which this risk could propagate. And giving your point of view and taking into consideration, in particular, the mechanism through the financial system. So is there some room to have macroprudential policies that could help in this line, or it's a kind of risk that really deserves only a micro approach? So what is your view? What central banks or supervisor or authorities that have a control of financial stability could practically do to contain this risk?
Yeah, it's a complicated question. you are very... it's a very interesting one, but it's complicated. I think that in the sense of this, what one could expect from central banks is at least the banks to internalize this risk in order for them, when the institutions take the financial decisions, to take into account that they could be a very important player on the energy transition if they decide to do so. But to incorporate this risk, at this stage, it's very hard to talk even about regulatory requirements, capital, or anything, given that we are still on the process of internalization of this risk. But also for the identification of opportunities. What it comes to mind for me is that what was done with the large exposures work, I participated on that regulation, which is obviously macroprudential, but it has its roots on the micro. But I think that also, having seen, for example, that there is a lot of overlapping portfolios there, something can be done by the authorities. There is a good deal amount. And then to see it reflects precisely on this type of risk should call for some regulation or macroprudential in particular. So I think that we are precisely causing a lot of these feedback effects by design. But again, to put some numbers there, it's important. I hope that I answer. I mean, it was complicated, but I did my best.
Let me ask you a similar question. And I understand the answer that you just gave, but I think it's very interesting what you do and try to measure the risks the way you do, coming from the scenarios and really accounting for all of the impact, including the overlapping portfolios and so on. The point is that it's not only up to individual central banks to put these policies, because nobody's going to be a first mover. Why would, the question is, who's going to pay for all of this? I mean, it's going to be costly for the bank to include these risks. And if they unilaterally do it, they're going to be put in a position of terrible disadvantage vis-a-vis other banks in other jurisdictions. So the difficulties in this is even more than what you just answered, because it's not at the individual level, but this has to be a coordinated effort. And it's going to be very difficult to put it in place. I don't mean to sound pessimistic, and I think this is wonderful, but I think that even there is let me put it this way, even a perverse effect on capturing the cost in a much better way, like you do it, because basically who's going to be footing the bill on this, it's an even more difficult decision. And the more the costs are, the more you accurately you measure them, the less incentives. An incentive to say, if you attack this in a more timely way, the costs are going to be less, is certainly not strong enough for anybody to start moving. Yeah. What I see here is that when you include everything, the costs are enormous. So not only I'm not going to move first individually, but why should we be paying, in a particular jurisdiction for climate change, whatever, which has been caused by other jurisdictions? So it's even more difficult because, again, it's not a decision at the individual central bank. But if we don't get a coordinated move beginning with everybody, it's just going to be very difficult. And to be quite frank, even this can have a perverse effect. When you are showing that the costs are so big, when you take everything into account, it's just very, very complicated. So to me, the question that I would like to ask of you is, don't think the central banks at the individual levels. What should they be doing in terms of a coordinated action? Should the BIS should be more into this? What should be done?
Yeah, that's a very tough and also very right. What I omitted is the part of the physical risk, because here the costs look enormous for the transition to take place. But if you see the impacts coming from physical risk, those are far worse. So as I mentioned, if you think that the transition is expensive, look at how it goes without the transition. So I didn't have the time to show the physical part, but the physical part, believe me, it's a place where it's a world that we don't want to live in. And the ticket that we have bought for climate change is going to last at least 2 decades. So the things are going to be worse and worse, at least for 20 years. Even if we stop putting carbon emissions into the atmosphere, it's going to be at least 20 years. So what this research is trying to encourage, is that the financial institutions internalize that there are important risks for everyone, but a lot of the action has to come from the fiscal authorities. It's not even in the arena of the central banks. And I know that this is even harder because it's more political. Central banks tend to be less political than the finance ministers. So, and again, you are very right in the sense that coordination is very hard. There are some countries who have put a lot of the emissions into the atmosphere, and some others that we suffer a lot because of climate change, that we didn't put as much emissions on the atmosphere, and we need to pay. And we are going to pay not only for the transition, but the impacts of the physical events. Mexico is prone to very large impacts for climate change. And it's only I think it's the 12th or the 13th country in terms of emissions in the world. We only produce like 1.2% of the emissions in the world. But the economic impacts are going to be huge in Mexico. And the same happens for some countries like in the Caribbean. They can have their economy completely wiped out, absolutely wiped out. 100% of the GDP. and they haven't put any emissions on the atmosphere.
But it's the same consideration. You are stuck with the physical risks. When they materialize, you're going to be stuck with the physical costs. And there's nothing you, as a small, let's say, emitter, there's nothing you can do. Even if you change, and if you recognize these risks, and if you start to do, you're still stuck with the risks, unless the big ones move. And that's the point. Where are the incentives of the big ones, which are, at the end of the day, going to be footing, they have to foot the bill. Where are the incentives for them to move? It's not even a coordination problem.
Yeah.
A problem is the ones that are really at the margin, putting the carbon emissions up there, they have to move. And they will not move. It's not a coordination. It's just 2 or 3 big, they have to move. So basically, this is very complicated, even over and above what you said. Because you, as a single country, can do anything. You can do, the central bank can do things. The fiscal authority can very well take into account this, and there's going to have an impact. They can do anything about it. Mm-hmm. Not even, if they act alone, they're so small in terms of what's coming that it's going to be even more difficult. So you see there another reason or an incentive not to do anything. Even if you do, even if you act properly, it's nothing. You're still stuck with the costs unless the big ones move. So very, very complicated. Yeah.
It is. What is incredible is to have some countries, I'm going to put some names, I'm sorry if someone gets offended, but for example, India. The scenarios for India are terrible, horrible, even worse than Mexico, far worse. And they are still very, very engaged into burning fossil fuels. I mean, they are going the ones to be the ones that have the biggest consequences. And also, in my view, some of the countries which think that they are safe from climate change are not as much as they think. For example, what happened in Canada. 2 years ago, I was talking with my colleagues from the Central Bank of Canada, and they said, well, we think that the transition risk is very important for Canada, but not the physical risk. And then we had this period of all the forest fires, huge, and all that goes. And in my view, the same could happen to Europe. Whenever I talk to my European colleagues, they always say, well, it's a problem more for the countries in the equator. It's not. The Mediterranean is going to be boiling, basically boiling. The south of Spain, south of France, Italy, Greece, the Balkans. The changes in temperature that I've seen working with climate scientists are huge, are a horrible thing to happen. And that is going to affect not only the temperature, but the production, the productivity, access to water. So many things are going to happen. So that's why I completely switched from financial stability into doing climate change and environmental things. Because the biggest risk, in my view, are environmental. So we think about, sorry, Leonardo, about the cyber risk, the technology, the artificial intelligence. I think that we might be wiped out as humanity because of environment rather than from the Terminators.
But let me tell you, it's the same problem, for example, in the case of India, because it's not who's going to foot the bill, let's say, spatially, but intertemporally.
Yeah.
Because always the politician they have small enough discount factors as not to care. And certainly they think the next generation is going to pay for this. My generation doesn't have to pay for this, so I will not do anything. So really, I think that's where the gist of the thing is. It's wonderful to have a good calculation of all these costs. To be saying and to be propagating this is wonderful, but I think that the gist is we have to solve how to make the big ones move. That's the whole point.
Yeah.
Anyway.